Exam 4 Study Guide, Chapter 13, Introduction to Leverage. So, leverage results from the use of fixed cost assets or funds, or debt, to magnify returns to the firm's owners. Generally, increases in leverage result in increases in risk and return, and vice versa. The amount of leverage in the firm's capital structure, or the mix of debt and equity, can significantly affect its value. There are two types of leverage: operating structure, which results from fixed operating costs, and financial leverage, which results from fixed financing costs. And this can be interest on debt, dividends on preferred stock, or lease payments. So in other words, operating leverage includes sales revenue less cost of goods sold, which then equals gross profits less operating expenses. And then from there you get into financial leverage, which is earnings before interest and taxes, or EBIT, less interest, which equals net profits before taxes, less taxes equals net profits after taxes, less preferred stock dividends, which equals earnings available for common stockholders, and then earnings per share is also there. The total of all of that is your total leverage. But leverage works both ways. Leverage makes good times better and bad times worse. Operating leverage and break-even analysis. The firm's operating break-even point, or OBP, is the level of sales necessary to cover all operating costs and expenses, both fixed and variable. At the OBP, operating profit, or EBT, is equal to 0. To calculate the OBP, operating expenses must be categorized as fixed or variable. Variable costs vary directly with the level of sales. Examples include direct labor and shipping. Fixed costs do not vary with sales volume, and examples of this include rent and fixed overhead. Using the following variables, the operating portion of a firm's income statement may be recast as follows. P equals sales price per unit, OBP equals sales quantity in units, FC equals fixed operating costs per period, and VC equals variable operating costs per unit. So the equation for this is OBP equals fixed costs over price minus variable costs. So if you have an increase in your fixed operating costs, it increases your break-even point, as does an increase in your variable operating cost per unit. However, if your sale price per unit increases, then your break-even point decreases. Again, operating leverage works both ways. If a firm has a fixed operating cost, an increase in sales will result in a more than proportional increase in EBIT, and a decrease in sales will result in a more than proportional decrease in EBIT. And this is why leverage leads to increased risk. So in order to calculate degrees of operating leverage, the degree of operating leverage, or DOL, measures how sensitive EBIT is to change in sales. And a company's degree of operating leverage can be calculated in two ways: internal estimate or point estimate. And only companies that use fixed costs in the production process will experience operating leverage. Don't think I can put that on there. So basically, if your sales go up or down by the same amount, then your EBIT will as well. So the changes are the same whether it's going up or down, I guess is that diagram. Can I flip? I don't think I can. Oh well, you're just going to be listening to this and you're talking to yourself. Yeah. Okay. So DOL equals percent change in EBIT over percent change in sales. But another way to figure out DOL is sales minus variable costs over sales minus variable costs minus fixed costs. So in order to calculate the degree of financial leverage and financial break-even point, financial leverage results from the presence of fixed financing costs. Financial leverage magnifies the effects of changes in EBIT on the firm's EPS, or earnings per share. And fixed financing costs fixed financing costs most commonly found are interest on debt, preferred stock dividends, and lease payments. I seriously need some water, so this is happening. I'm talking to myself while I get water. Okay. So the degree of financial leverage, or DFL, measures how sensitive EPS is to changes in EBIT. And this can be calculated in two ways: interval estimate or point estimate. Only firms that use debt, or other forms of fixed financing, like preferred stock or lease payments, will experience financial leverage. So if the EBIT decreases, then the EPS also decreases. If sales remain unchanged, then EPS also remains unchanged. And if EBIT increases, then the EPS does as well. So the way you calculate the degree of financial leverage is percent change in EPS over the percent change in EBIT. And for the point estimate of degree of financial leverage, you have DFL equals EBIT over EBIT minus interest. And you have to do that twice for, I think it's like a case 1, case 2 scenario. I'm not really sure. But from there you subtract the two of them and then figure out what the difference is and all that fun stuff. So your financial break-even point equals your interest payment, and your financial break-even point also equals the level of EBIT that causes earnings per share to equal 0. Moving on to total leverage. Total leverage results from the combined effect of using fixed costs, both operating and financial, to magnify the effect of changes in sales on earnings per share. And total leverage can therefore be viewed as the total impact of the fixed costs in the firm's operating and financial structure. So the interval estimate of DTL is DTL equals percent change in EPS over percent change in sales. DT also equal DOL times DFL. Cool. Which is the same result we obtained using the interval estimates at the sales level. Which is basically saying that those two equations are the same thing. Alrighty. Ideas and theories that determine the optimal capital structure. Or what are the pros and cons of using debt? So these decisions are a very complex area of finance. Poor capital structure decisions can result in a high cost of capital, lowering project net present values and firm value. A firm should maintain a capital structure that maximizes shareholder wealth, and there are significant differences in capital structure or leverage among industries. Optimal capital structure, some insights into this include there's no magic formula. Again, leverage works both ways. It makes good times better and bad times worse. And you can identify some benefits and costs and other influencing factors of using debt. Investment choices trump financing choices. As for bonds, some advantages include cost is limited and generally fixed. Interest is tax deductible, lowering interest cost. Less dilution of control and earnings. This also translates into a stock disadvantage. Call feature gives refunding flexibility. It lowers the cost of capital. Good aspects of leverage. And low interest rates. Some disadvantages of bonds include fixed interest costs and legal obligation to pay interest, increased risk and increased chance of failure. Maturing bonds must be repaid. Restrictive covenants, bad aspects of leverage, and stress on management. Other influences on capital structure choice include revenue and cash flow stability, control, level of interest rates, management preferences, and religion. Capital structure theories include the static trade-off theory, which balances the benefits of debt against the costs of debt, and substitute debt for equity until firm value is maximized. And then you also have the pecking order theory, which is internal financing or retained earnings, debt, and equity. So that's the order in which they go in. And then common stock is after equity. Can't really put that into words so much. So the EPS EBIT approach is a method of selecting the firm's capital structure by determining the debt percentage that maximizes earnings per share. And the emphasis is on maximizing earnings per share. A major shortcoming of this approach is that earnings are only one of the detriments of shareholder wealth maximization. Also, this method does not explicitly consider risk. Evidence that 60% debt level is risky, so higher financial break-even point, steeper slope of capital structure line, lower times interest earned ratio. So if you were to compare these, 0% on $100,000, it could go on for infinity. 30% with $1,000, that's 6.67 times interest earned ratio. And with 60%, it would be a 2.02 interest earned ratio. So although EPS maximization is generally good for the firm's shareholders, the basic shortcoming of this method is that it does not necessarily maximize shareholder wealth because it fails to consider risk. And if shareholders did not require risk premiums or additional return as the firm increased its use of debt, a strategy focusing on EPS maximization would work. But unfortunately, this is not the case. So I'm going to close it out. Well, should I? Probably not, but I will check my battery, which is at 6%, which means I need to plug in for the rest of this. Otherwise, I will not make it, and I won't have any video, which would not be good. So, just talking to myself, no big deal, la-da-da, finance. Your final is tomorrow, and then you are done. Plugging in the phone now as I continue talking to myself.